Okay, hi everyone. This is going to be the first lecture for chapter 20. We're talking about partnerships now, so we're moving away from the corporations and the corporate world, and we're looking at partnership taxation. Now, in the same way that we looked at kind of the life cycle of a corporation, right? Like forming it, its operations, and then kind of wrapping up or distributions from the corporation at the end of the road. We're going to be looking at a similar thing with partnerships, kind of the entire life cycle. And this chapter specifically is going to be looking at the formation and the operation of partnerships. What are the tax consequences of doing that? So we know partnerships file the 1065, right? And we also are aware that there is only a single layer of taxation when you're taxed as a partnership. That is to say, the entity itself, the partnership, when it makes money, it as an entity does not pay tax on that. Instead, what happens is the income flows through to the owners of the business, namely the partners, and they pay tax on the earnings. So for every dollar the business makes, there's only one layer of taxation. One time it is taxed, and that's at the partner level. In distinction, right, we said with corporations, there's two layers of tax, right? When the corporation makes money, it itself as an entity has to pay tax on that. And then when it pushes out the money, its earnings out as distributions, the shareholder then has to pay tax on that. So there's two layers of taxation there. Now, as a general rule, right, when we're talking about partnerships, general partnerships, limited partnerships, LLCs, the general rule is going to be when you have two or more individuals coming together to run a business, you are going to be taxed as a partnership under the check the box rules and the default rules. Now, you could alternatively, if you wanted to be a legal partnership, you could choose to be taxed as a corporation. That's a possibility if you check the box to do that. Likewise, if you wanted to, after you check the box to be a corporation, and assuming you qualify, you could then elect to be an S Corp, taxed as an S Corp, which is a type of flow-through entity. So general rule is going to be, two or more individuals coming together to operate as a business is going to be taxed as a partnership unless they elect otherwise. One of the things they can do is they can elect to be taxed as a corporation. And if they really want to be a S Corp, they would first have to be the election to be taxed as a corporation, then choose S Corp status. Now, when we're talking about partnerships, right, under the tax law, they kind of have different theories for how they would tax a partnership. There's the entity approach versus the aggregate approach. And the IRS code and the government, they kind of use both approaches. So what's the difference between them? Well, the entity approach treats the partnership itself as a separate entity from its owners, from the partners. So, for example, the partnership itself as an entity is going to make certain tax elections, like what's going to be our tax year end, things like that on the tax return. In distinction, we have this thing called the aggregate approach, which basically treats the partnership as kind of a bundle of different interests. The partnership is nothing more than just the collection of all of those partners' individual interests. And those are represented by the assets and liabilities within the partnership. So this approach would be shown, one way it's effectuated is through the fact that the partnership itself doesn't pay taxation. Instead, it flows through to the owners, right? That's kind of the aggregate approach. This is really the partnership as just a collection of ownership interests. In that way, when the partnership makes money, it itself is really just a conduit for its owners. So when we're talking about forming a partnership, when it's formed and after it's formed, like once it's up and running, you can have partners who can enter into the business and they can be partners. They can do this through transferring cash, property, or services, right? Here's $1,000, please make me a partner in the partnership. Here is a building, please make me a partner in the partnership. I will provide legal services for you and you can make me a partner in the partnership. Now, when you are a partner in a partnership, you're going to have two types of interests. You could have a capital interest or a profit interest. A capital interest basically just says, hey, if this partnership were to be liquidated, I have the right to receive my proportionate share of the net assets, like what's left over after they pay off all the debts. In distinction, a profits interest essentially says, hey, I have a right to receive my share of the future profits or losses generated by the business. Now, if you were to contribute property or cash, normally you would get both of these interests. However, partners who contribute services, they generally only receive the profits interest. They don't get the capital interests. And part of the reason for that, right, they didn't really put any assets in there to begin with. They more provided services. So when we're talking about partnerships and forming them, the same kind of underlying logic that applied to corporations, like forming them, is going to transfer over, right? In light of giving property to a business to become an owner of that business, we don't want to tax that event, right? That would discourage people from forming partnerships. Accordingly, what we're going to do is, even though you technically have a disposition event, right? You give a machine to a partnership, you've disposed of it, you could have a gain or loss on that. Instead, we will defer the gain or loss from the partnership, from the partner in the partnership, by adjusting their basis in the partnership, basically to encourage them to contribute property. And this essentially is going to take the aggregate approach, right? Because it's looking at the individual partners and it's saying, hey, you contributed property. You now indirectly own that, but at an effective smaller ownership percentage. So when you're contributing property, right, as I indicated, the general rule is going to be no gain or loss for the partners there. However, when you contribute services, this is going to be taxable, right? It's like you're earning something. You're providing bookkeeping, you're providing legal services, you get something in return that's like, active earned income you have to report. With this dynamic, right, the setup, it's going to encourage people to transfer built-in gain property. However, it will discourage the opposite, right? You don't want to contribute built-in loss property. Let's see that here in 21, right? So we have a partner, they contribute land that has a fair market value and an adjusted basis of 20,000. It's built-in gain property, right? How much gain or loss does the partner recognize? In this case, it's going to be zero. Right? The general rule is that a partner contributing property is not going to recognize any gain or loss upon contributing it. Here's the same facts except with a built-in loss property, right? Something with a fair market value of 120, but an adjusted basis of 220, right? You'd have a built-in loss there. In this case, even though you contributed something and you had a disposition event that would have that otherwise would have generated a loss, you don't get to use that loss, right? You still have zero gain, zero loss. This is why the book was saying, it discourages people from doing this. What that partner really should do is they should sell this property first, take the loss, right? Maybe at least you can use that in some capacity, offset ordinary income if it's a certain type of property, or if it's capital gains, get something out of it, right? And then when you get the sale with the proceeds from it, use that money to invest in the partnership. The next thing we're going to talk about is basis versus capital account. So basis right here is really, really, really important. When you take the CPA exam, right, there's 4 parts to it. There's financial accounting, there's business, there's auditing, and then there's regulation, or basically it's tax/business law. And in that, when you take it, almost everybody who takes it says, man, I had so many questions on basis, whether it's your basis as a partner in a partnership, your basis as a owner in an S corp, or a shareholder in a corporation. Basis is like critically important. Capital accounts, in distinction, are more of like an equity type account. They're less relevant, so we're going to spend less time on those. But basis is a big deal, and we are going to look at that. So when we're talking about a basis, right, there's 2 types. There's outside basis and inside basis. You can kind of think of it from like the vantage point. Outside means outside the entity, inside means within the entity. It basically says this: your outside basis, when you're talking about a partner in a partnership, is really just your adjusted basis. It's what you're looking at that represents your ownership interest in the business, how you would quantify that. And just to give you a simple example here, right? Let's just say you gave $10,000 to a partnership, and now you are a 10% owner. That's great. There you go. That partnership interest you own, that's an asset, right? In fact, it can be a capital asset. And if you sell that to a third party, right? Say that you invested in a partnership, you're a 10% partner. Then you have a third party who comes to you and says, I will pay you $30,000 for that 10% ownership interest. Well, that's great, right? But we know, first off, because this is an asset, a capital asset, and you've disposed of it, we need to figure out what your gain or loss is, right? It would be a disposition event. It triggers the amount realized minus the adjusted basis. So in that case, if the individual offered you $30,000, that's straightforward, right? To know what your amount realized is. Where you would need to know your adjusted basis, that would be the equivalent of your outside basis. So in this case, it was just cash. Your outside basis would be $10,000. So you'd have a $20,000 gain. Now that's a very simple example, but if we're looking at like what is outside basis, that's why we care about it. It's the partner's basis in their partnership interests. If they sell their interests, we need to know this because it can help determine the gain or loss. These bases rules and other items come into play when you're looking at the passive activity loss rules as well. So just be aware that basis is a big deal. The inside basis, in distinction, is the basis the partnership has in the partnership assets. So, for example, right, if 3 individuals form a partnership, one contributes a building, one contributes a vehicle, and another contributes land. If the partnership was to sell or dispose of these assets, what would be its basis in them, right? We're looking from the partnership's point of view. So let's look here at 22, right? So assume we have a partner, they contributed $120 in cash to a partnership for their interest. What's their outside basis? Straightforward, cash. It's going to be that. Now, one of the things here that we're going to talk about with outside basis, when you contribute property to the business, right? Things like land, buildings, equipment, so on or so forth. The general rule in that case, as we see here, is your outside basis is going to be the adjusted basis of the item you gave. So basically take a carryover basis. So here, right, if we contribute land with a fair market value of 120 and a basis of 20, now when we say that, we mean in relation to us, the partner. We're saying the partner, I bought this for 20 grand, now it's worth 120. What's my outside basis in my partnership interest? Well, in this case, you just take a carryover. Whatever your basis in the property you contributed was, that now represents your outside basis. And really what we're doing here is we're deferring the gain, right? You had a built-in gain here of 100. If you were after the fact to sell your partnership for the 120 and you backed out the 20 adjusted basis, there's the gain that you deferred. So defer it up front when you contribute it, recognize it on the back end, when you were to dispose of the property. This is where things get a little bit more complex. So let's just begin with the premise here that with regard to property, not all of the time are you going to outright own that property, right? So for example, your house, if you have a 30-year mortgage on your house, until you hit year 30, there's going to be a liability attached to that property, right? Very few assets are fully paid off. Sure, you could buy your car with cash, or if you were really rich, you could buy your house straight up with cash. But that's kind of the starting point, right? If we were, not everybody's in a position to give free and clear property with no debt attached to it. So with that being said, when debt comes into play, there's some additional steps we have to consider here for outside basis. First, as I have here, each partner must include his share of partnership debt in the outside basis because each partner is treated as borrowing his or her proportionate share of partnership debt and then contributing the borrowed cash to acquire their partnership interest. Now, when we're dealing with debt, right, we'll look at how this shakes out. There's two types, and there's different types of treatment for them. There's recourse debt right here, and then there's non-recourse debt. Recourse debt basically means this. If you have a recourse debt, you are personally liable for this. If the partnership, can't pay this debt off, they're going to come to you and they're going to take your car and your house and whatever money you have in the bank, right? Non-recourse debt, in distinction, basically says the person is not personally liable. They can really only go after the property in question. So, like if you contributed a building that had a mortgage on it, the best they're going to be able to do is go after that building, right? They can't come and take your car or your house. So recourse is kind of like, personal liability attached to it. Non-recourse is like less intense. They can't come after you personally. Now, one of the things here is for recourse debt, you're going to allocate it based on responsibility for paying the debt. Whereas non-recourse debt, you're going to allocate it among the partners based off profit sharing ratios. Let's look here at 23. Okay, so it says we have, the same setup here. Let's imagine there's 3 partners in a partnership. 2 of them contributed 120 grand cash. And in addition, after the fact, the partnership as an entity borrowed $60,000 from the bank. The bank requires partner 1, 2, and 3 to personally guarantee the bank loan, right? So in this case, right, we're starting here, and it kind of is going to unpack itself a little bit because we introduced this fact with kind of contributing property that has a debt on it, but it kind of cuts 2 ways here. The way it's cutting here is when the partnership itself takes out debt. We're going to see as we move forward how where the first example is true, namely when there's property contributed with a debt, how that works. But let's just, keep in mind here that we're talking about debt. There's in a partnership, there's recourse and there's non-recourse. Here we have three partners. There's two of them that contributed cash. The partnership itself then borrowed money. The three partners basically personally guarantee this loan. They say, hey, we're partners in this partnership. The partnership borrowed 60 grand. We agree to be on the hook for this. So we know there, right, recourse debt, we're going to allocate it by responsibility for paying. So in this case, we're all equally responsible. It says here, each partner is responsible for the portion of debt equal to their percentage of losses allocated to the partnership. So in short, right, 1/3, each of them personally guarantee it. The partners have no right of reimbursement from either the bank or the other partners. How much of the debt is allocated to each partner? So in this case, essentially what happens is the partnership borrows 60 grand. There's three partners, each are on the hook for 1/3 of it. So that's $20,000. This debt is recourse debt, right? They can come after the partners individually and come after the personal assets. So in this case, right, one of the things we have to be aware of is, as we indicated right here, when the partnership has debt, there's additional steps. So in this case, we have to increase our outside basis for our share of the debt. So it's like 120. This partner one started with, they are now on the hook for the additional 20. Their outside basis is going to be 140. Now, you can read this here, but this is like kind of the first when I was like at a starting point. Let's start with this. This is the situation where we have to be aware of partners contributing property subject to a debt. So we talked about when the partnership has debt, we have to look and see, is it recourse? Is it non-recourse? Then we allocate it to the partners based off these criteria. The second idea here is when a partner contributes property subject to a debt, like what I was saying with like a house that has a mortgage. This is puts the second twist on it. So here, right, when a partner contributes property subject to a debt, and then the partnership assumes this debt. So hey, here's a $100,000 building with a $30,000 mortgage attached to it. The partnership is now going to assume this liability. We as the partnership are on the hook for this. Here, the contributing partner, the person giving the building, the land, they have to treat this debt relief as basically a type of distribution, right? And that's going to reduce their outside basis. So if you think about it, right, it's almost like cancellation of debt income. Yeah, I gave this $100,000 building that I had my basis in it, but I also got off the hook for 30 grand in that case. Now, to make things even more complicated, right, if the debt securing the property, okay, so we have a partner contributing property, just say a building with $30,000 of a mortgage attached to it. If that's non-recourse debt, right, they can't individually come after the partner, they can only go after the property itself. This is where you have to read it carefully. The amount of debt in excess of the basis of the property is allocated solely to the contributing partner, and any remaining debt is allocated to all partners according to their profit sharing ratio. So that's kind of a mouthful. Let's look here at 24. Okay, so this example is kind of a staple. It builds off this as we go forward. So we have a partner, they contribute 10 grand cash in land with a fair market value of 150 and 20 adjusted basis. Okay. The land given to the partnership had a $40,000 non-recourse mortgage. So what we're saying here is we had a partner contribute property, that land, it was subject to a debt, a mortgage. Now we have to treat this debt relief as a deemed cash distribution. However, this was a non-recourse debt, so that means we have to apply this kind of funky rule here. The debt in excess of the basis is allocated solely to the contributing partner, and the remaining debt is allocated to all partners according to their profit sharing ratios. Okay, so same facts here as before. The partnership itself has an independent freestanding debt of 60 grand where they're 1/3 liable. They want to know here, what is partner one's outside basis? So this is kind of the new twist on it. Let's see what's going here. So we have, first off, all of the yellow things we're going to look at here. We contributed land, right? The partner one did. They contributed cash. They also have, for the partnership, the independent loan, the partnership that they took out, they're on the hook 20 grand, right? The next thing here is this relief from the mortgage debt, right? They got off the hook for 40,000 right here of what they owed on the land, right? So we said here that we have to treat this debt relief as a deemed distribution, and that reduces your outside basis. This is, the second paragraph right here, what they're doing in these two lines. So what they say is, so it's a non-recourse debt. The debt in excess of the basis of the property is allocated solely to the contributing partner. Okay, so the debt in excess of the basis of the land, our basis to the partner was 20 grand. The debt is 40. So the debt in excess of that, the 20,000, that's allocated just to the partner who contributed the land. Okay. However, there's still the remaining, in this case, $20,000. So right, we have 40,000 here that we looked at. $20,000 we have specifically assigned to the first partner. We have a remaining $20,000 we have to allocate. We do this by the profit sharing ratios. So in this case, it looks like the profit sharing ratios are going to be 1/3 each. So that's how you get that here. So basically, the land that was contributed, the cash, their share of the partnership's liability, their relief from debt on the property they contributed. Then once that debt is in the business, we said to the extent the debt is in excess of the basis of the land, we have to individually allocate to the partner. And what's left over, we break out by profit sharing ratios. So that was kind of a mouthful there. But essentially, right, we were talking about debt. We said there's two categories here. One is debt that the partnership itself has and how that affects basis. We said, and then the second type is when a partner contributes property that's subject to a debt. And then we said anytime there is debt, we need to make sure we are aware of recourse versus non-recourse. Moving on here, right? Partners are generally not going to recognize gains on property contributions, right? We said you kick the can, you defer the gain. Interestingly, right, this is kind of counterintuitive, you wouldn't think this, but partners can recognize gains if the cash deemed, right, so it's not real cash, it's the cash deemed to have been received from a partnership distribution exceeds the partner's outside tax basis in the partnership before the deemed distribution. Here we're going to have capital gains. It's almost like this, right? Imagine you buy Apple stock for $100 and then Apple gives you $300 for your ownership interest, right? $100 of that is going to be return of capital. $200 is going to be a capital gain. It's kind of like that here, but basically what happens is, in a nutshell, right, it's going to be a deemed distribution. So what this basically means is maybe you put some property in, you get a huge debt relief on a mortgage attached to it, and that debt relief is going to outweigh your contribution, such that the deemed distribution from that debt relief is going to push you into capital gains. So let's look at 25 here. So two partners guarantee $100,000 of debt on the business. How much will the third partner who doesn't guarantee this debt recognize on our contribution to the partnership, and what's the outside basis? So this is drawing from some of the facts before, but modifying a little bit. So they do, let's just say partner one gives land, cash. They're not on the hook in this case for the mortgage because the other partners are personally guaranteeing it, but they do have the deemed distribution from the debt relief, right? So basically they put 30 in, but it's like they got 40 out because they got off the hook for 40 grand. This is going to be treated as debt relief in excess of basis, effectively a capital gain, and your outside basis is going to be 0. Continuing here. So partnership interest is a capital asset. Thus, the holding period is going to determine whether it's short-term or long-term. If the partner contributes assets or 1231 assets, the holding period of that property is going to carry over to the partnership interest. So generally, you look at your partnership interest and you say, did I hold it for a year or more? Is this short-term or long-term? And that would be if you just did cash. If you gave property for your partnership interest, you would then look at the holding period of that property. So let's look here at 26. So assume we have a partner who contributes land. They held this land for 5 years. 1 month after they contribute it, they sell their partnership interest. What type of gain is this? Well, it's going to be a capital gain. And because we look at the property that was given to determine the holding period, right? You just have a carryover basis. In this case, because you held that property for a long period of time, the partnership interest is then effectively going to be given that long-term capital gain treatment, even though you only held it for 1 month. So look to the property that's contributed, not necessarily, if it was just cash. The next thing here is inside basis. So we said inside basis is important. We need to know about this. Because if the partnership itself sells contributed property, we need to know, how does this inside basis affect it? Generally, the partnership is going to take a carryover basis at the time of the contribution. Whatever the partnership or the partner had, the partnership's going to have. The holding period carries over, but the character of the property, in this case, we have to look to see how the partnership uses it. So if we looked at 27 here, assume a partnership used land contributed by a partner in its business for 1 month. It sold it for 150 grand. What is the amount and character of the gain? Well, to the partnership. So we have 150 it sold it for. It's going to take a carryover basis, right? The partner had a 20 grand basis in it. So now the partnership there's going to be 130 gain here. The character of it is going to be 1231 because that's how the partnership itself used the land. Finally, here in the last couple slides, you can look at the capital account information. Basically, what it's used for is to track the equity of the owners of the business. That's what the capital account's for. You can use 3 different bases for this: the GAAP, the tax, or the IRS Section 704B amount, like book, tax, and then 704B. You can read this and look at it. I'm less concerned about it. I think basis is a lot more important. So capital accounts are just equity accounts. They're showing another way of ownership interest. Similar to basis, but different. don't necessarily want to go down that rabbit hole right now. So with that, we'll end it here. We looked at an overview for the first 15 slides.